what we're doing because we're traders. And folks, I've known Joe a long time. I've been lucky enough to enjoy a lot of good meals with Joe and some concerts
Yeah.
because this is a guy you should know, folks, if you want to go to great concerts. Because Joe and I've been to concerts with Slash, with Bon Jovi, with Neil Diamond.
Neil Diamond, I know.
So many concerts, I can't remember them all. But then, of course, with Phil X.
That's right. That's
That
right.
dude is amazing, Joe. Anyway,
Amazing guitarist.
yep. Joe knows these folks because he used to live in Vegas, and a lot of musicians, because they're sort of vagabonds and traveling the globe, they end up, if you're gonna have a place to have your house, just like traders, why not Vegas? Because
Yeah.
zero state income taxes, right, Joseph?
Yeah, Nevada zero. It's also great for traders. No state income tax for traders. Nevada, Texas, New Hampshire, whatever the handful of states that offer that. It's a good Florida. It's a great thing.
True. Well, so let's go into it, Joe. It's been a crazy couple weeks, crazy month. I know you've been trading up a ton because you've been posting up every day, folks. Joe posts up what he's been doing. You can follow him pretty easy. His handle is JFAHMY.
Yeah.
That's J like John, F like Frank, A like Alpha, H like Harry, M like Miami, and Y like Yahoo. And he posts up funny stuff, usually after hours, sometimes during market hours, but he posts up great, insightful stuff as well. So I'd encourage you to check out his Twitter handle, JFAMI. But Joe, tell us what you've been looking at maybe as this thing started and what you're focused on now that we're in the midst of some sort of relief rally.
Yeah, I mean, for people who don't know, my general philosophy is I believe the market's healthy 2 to 3 times a year. Mainly thinking from the long side. So what I try to do is identify when it's healthy, expose client capital to, and I'm mostly trading individual stocks, some ETFs, but mostly I'm a growth manager, mostly individual stocks. And I just try to identify when it's healthy and expose client capital during those times. And then when I don't see that it's healthy, I do try to reduce to try to, so it's sort of that big discussion, passive versus active. Which we can talk about that as if you want as well. I think there's nothing wrong with having a little bit of both, meaning having some passive stuff, maybe some index, some long-term stuff, and having also some active and taking advantage of individual stocks that can really, make a difference to your, returns, to your portfolio, to a lot of things. So, yeah. I mean, as far as a lot of people say, okay, that's a great philosophy. How are you judging when the market's healthy or not? I'm using, some moving averages as an indicator, not it's not an end all be all indicator, but I'm using them as if we're above certain averages, it's a sign that the institutions are supporting the markets and the market's healthy. And if we're below that, it's an indication to reduce risk and to reduce exposure.
Right. Well, so as an example, Joe, do you have any stocks that you were talking about as far as reducing exposure in those names? For instance, January, February. I remember January when it started off, Joe. In the first 2 weeks, I thought it was a gift. I said that on halftime, and I told the judge, I said, "Hey, I'm lightening up here." And when I was doing it, then a lot of them were not so much giving me crap, but they're trying to draw out of me why I'm lightening up. And I certainly didn't see this coming. I did not see a global pandemic, that would drive the market down thousands and thousands of points in the Dow and, take us down 30% in the S&P. I didn't see that coming, Joe. I just thought it was a gift, but I didn't have to sell my stocks in December, and I could sell them in the first couple weeks of the new year at even higher prices and kick out my taxable liability into 2021 instead of 2020, instead of paying it April 15th, which I thought we were going to have to pay. Now it's pushed.
Even that's been extended. Yeah.
Yeah, that one's been extended.
Yeah. Why do
But
we have to
still,
pay taxes, by the way, if the Treasury can just print all the money they want? That's the thing I don't get.
yeah, well, we can get into that too. It's a crazy world, Joe. But it's interesting how many people that aren't in our business that just go back and forth with you and me on Twitter or Facebook or wherever they might, talking about trades, but not trading. And
Yeah.
it's like, I mean, I guess there are people that might want to talk with a stripper about stripping or something, but um, I don't get it. I mean, I'd rather be involved.
Yeah.
If I'm going to go to a strip club, Joe, I'm going to be talking not to the other guys at the strip club, if you know what I mean. I'm a happily married guy now, but
why do all of our conversations turn into conversations about strip clubs?
It's because we've spent too much time in Vegas. That's why.
I mean, I think people can tell if they hopefully have half a brain who's trading and who's not. I think if you are a trader, you get a feel for who's a trader.
Yep.
But I mean, look, and there's also some people who are, passive and they're just posting stuff or whatever informational stuff on Twitter. There's nothing wrong with that. But I think, for people who are traders, it's important to, I mean, there's just so much that goes into it. I mean, I'd say 80% of it's psychology. 80% of it's having your head right and making sure you're coming from a strong, mindset. So you're not, so like right now, you're right. No one expected this. I actually was not planning or kind of counting on a pullback, after April, May, when the Fed was going to slow down their repo purchases, when Powell said we'll probably slow down at the end of April. I was thinking a pullback would come then. Obviously, no one had planned this. And even the pullback that I was planning for was your average garden variety, 10 to 12, 14. I mean, every year the market averages a 14.5% intra-year decline. I thought maybe we could get that in April, May, June, maybe some sort of correction in the summer. But this caught a lot of people off guard, and not only because of how fast we declined, but the velocity, not just the decline, the percentage decline, but how fast it happened.
Yeah.
And that strikes an incredible amount of emotions. And people, I mean, you see it on Twitter and social media. People are, it's a stressful time, but the higher the volatility, the higher the emotions. And one thing I always try to stress is you got to keep your emotions in check. If you notice some of the in interviews that the judge had recently with someone like Tepper, with someone like Paul Tudor Jones was on recently, some of these sharp money managers, I refer to Druckenmiller as well. One thing I love and respect about them is how calm they are. They're not emotional. They're not screaming on TV. They're just very, very, have a lot of conviction. They're very, very calm in their emotions. And they're just, look at things. They're very flexible with their point of view. And I think that's important that all traders can learn from.
Yeah, well, that's very true. I mean, even when you're hearing somebody like you just said, Pepper, and I'll throw out Mark Cuban, you rarely hear him screaming. No. I mean, he's saying, hey, I'm putting 1.5% in here. I don't know if it's the bottom. None of us do. None of us know if it's the bottom. And we certainly, as I just said, I don't call tops either. But I think there's plenty out there, Joe, to catch, a stock that has fallen dramatically. I mean, for instance, I had talked a lot over the last 2 weeks about Boeing. And the reason I had was, the stock just got its butt kicked. And they drew down that $14 million, I'm sorry, 14 billion, not million, $14 billion credit line because they had to. I mean, because if they didn't, maybe it gets taken away, Joe.
Yeah.
They were worried, what if things seize up? We can't afford not to do this. So they did it. And then the stock fell even further and harder, faster, all the rest. Yeah. And, it was hovering around $100 and breaking through 100 to the downside. And I said, how long before Warren Buffett steps up and says, I'm just sitting here thinking, Becky, that this is a great buy down here. And maybe I give them a bunch of, maybe I give them 14 billion and maybe they give me a bunch of upside calls and, blah, blah, blah.
Yeah.
I thought that was coming, Joe. I really did. I wasn't just making fun of Buffett's speech pattern there. I really thought we would see that. If we stayed there, and maybe we'll go back there, we don't know. But if we stayed at par, $100, I thought we would see him or somebody else stepping in and saying, okay, I'm not going to buy the whole company, but this is a duopoly. You know, there's only two plane makers in the world really of scale and size. You know, we know there's Bombardier. We know there's the Canadian Bombardier, and down in South America, Brazil, I think they've got the other maker, but they're small regional jets.
Right.
As far as, you know, hopping across the pond with 200 plus passengers, there are two of those, and that's Boeing and Airbus.
An Airbus, yeah.
Yeah, and they're also both big defense contractors, Boeing and Airbus. And they make helicopters. In the case of Airbus, in the case of Boeing, they're in the space business too. So they're like a can't fail. They've got to be supported kind of company. And, you know, that bill that made its way through the Senate last night, Joe, that bill has 60 billion in bailouts for Boeing and related companies.
Yeah, I mean, you make such a great point. Not only are they involved in so much, but the supply chain that would be disrupted with the parts and all that. I mean, people really underestimate. I know some friends who are engineers, and their company is strictly supplying parts to Boeing. So, I mean, there's just the domino effect. If you let something like that fail, you know, you're right. Just that was something that was just not going to happen. Now, they do have a lot of debt, and they were having problems anyways before because of the MAX. But you know, and I know you guys talked or caught about some unusual activity. That was interesting because some unusual activity came in Monday with, I think, some May call spreads, like first thing in the morning, and the stock was under 100. And then boom, it shoots up to, I don't know, whatever it went to, 170, 180, which is pretty amazing. Which is what I love about what you guys do. Even though I don't necessarily trade options, I'll use that information to help me to maybe get into a stock or stay with a stock that I might find. So the option activity is great. Even if you don't trade options, it can really help you with the equity side as well.
Yeah, oh, well, I of course agree. And here's what Joe is talking about, folks. Here on the screen, Joe, are the middle of March, 8 days ago, you know, when the stock's 98 and 100, you see them buying upside calls. Then this week, 2 days ago, so we're at Thursday, this is Tuesday, like you say, Monday and Tuesday, they were buying calls. And that was after the stock made that 25, 30% jump from par to 125, 130.
Yeah.
At 123.63, they bought calls that expire tomorrow, paid $6 to $8 for them, Joe, like 4,000 times. And that wasn't the whole volume. That was just when we put this one up just after the opening that day. Yeah. Well, obviously today with the stock over 180, these calls are worth $50+ and I think you get opportunities like this. You know, this one's not to tout our deal and say, oh, we're the greatest thing since sliced bread. I think we're pretty good at what we do, Joe, and thank you. There's the chart. But I think that you get great opportunities. And I have said it many times, I bet you have as well, Joe, that panics create the best opportunities that you'll ever see.
Yeah.
And sometimes that's the fear of missing out, FOMO. Yep. It was certainly that way with like Bitcoin when it traded up to 19,000, almost 20,000. That was the fear of missing out. All of a sudden, people that had never, ever owned a coin wanted to own a Bitcoin. And they scrambled in at the end of gosh, I'm forgetting now even. Was that 2017, Joe?
Yeah, it was either 17 or 18. I think it was early 18. I forget. But yeah, that was, I think it was 18.
Yeah, scrambled in.
It went up throughout those 2 years, yeah.
You get panic buys both ways, folks. People that just need to get in because they're afraid they're missing out on the best opportunity. I think, Joe, some of the best opportunities, I thought it was funny, our mutual friend, Josh Brown. Joe and I have been out to dinner with Josh before, folks. And I thought it was funny that when Josh and Ricky Sandler were going at it a week ago on Friday. Ricky, in case you don't know him, folks, Ricky Sandler, I'll try to get him on the show soon. But Ricky is a guy who manages a $7 billion book of long short. You know, it's a true hedge fund. And he also has a $2 billion fund that is, I believe, Joe, long only. But he was just saying, hey, when this is over, Vegas is going to be raging. He said, people are going back on cruises and blah, blah, blah. And Josh was doubting him and laughing at him and things like that. And I know Ricky had the last laugh, at least for the last triple that we've seen out of some of those stocks, because you want to pull. In fact, Joe, since you've got the charts and stuff, can you pull up whether you want to pull up MGM or Wynn? We know them both well, you and I.
Yeah, let me.
I don't imagine you're in either of these right now. If you were, you probably took profits on this run. But have you been nibbling at these on these dips? Because I've been in them for a day and then out. I was just afraid, you know, if I overstayed my welcome, I'd get killed.
Let me pull this up. You can see the charts.
Yep, I see it.
Okay, yeah. Yeah, this is an example with MGM. Yeah, that was down here. I was low, I don't know, right around $8 or something like that. I mean, you can see the decline here. And same thing, I think Ricky was talking about Wynn.
Yep.
And see, this is where, you know, it's a great point. We always talk about trader versus investor. This is an example of, if I think it's important for people to define themselves and say, okay, if you're a trader, I've been preaching, or not preaching, I hate that word preaching, but I've been talking about keep things light if you are trading, because we have such crazy volatility. So let's say my holding time's anywhere from 2 to 3 weeks to 2 to 3 months, in that range. But let's say I'm going for a 20% move or 30% move in a stock. I'm not necessarily planning to day trade it or trade it in 1 or 2 days, but if you get that type of move because of the huge volatility, there's nothing wrong with trading shorter term. And so if you're a trader, because we're not moving, you know, 0.5%, 1/4% every day, we're moving 5 to 10% for the last few weeks, it seems like, you're going to have greater volatility. So you might want to lower your position size, because you're going to get these crazy types of moves. Now, if you're an investor, or let's say you're a value manager, or you're just looking for bargains, you're not necessarily using technicals or looking at the chart. You're just saying Wynn used to be 150 at the beginning of the year, and now it's below 50. And you're not saying, you know, if you're an investor, you're not looking for a cup with handle or any sort of technicals or anything. You're just saying this thing is off 60, 70% off of its highs, and I'm going to start to nibble here, which is what Tepper said. Tepper said, I'm nibbling here. He says, I can accept we might go 10% lower, but I'm nibbling here. And that's why I've said sometimes you just say to yourself, if you have conviction, which, you know, some people do, and it's something you like that you either missed, you might own, have wanted to own longer term, and it's down 50, 60, 70% off of its highs, there's nothing wrong with nibbling here, because, you know, if you're not going to do it now, what are you waiting for, is my point. You know?
When are you going to find a better opportunity? Joe, can you shorten that thing up to like 5 days or a month or something like that?
Let me look at like a 60-minute chart.
Okay.
Yeah.
Yeah, because look at that. What he's pulled up there, folks, is, you know, when you see that last week, the stock was, you know, it bottomed apparently for the short term.
60-minute chart. So this is March 1st right here. Beginning of the month, it's over $100, and, you know, beginning of the year, that's what I was talking about, 140, 150 beginning of the year. But sorry, go ahead.
No. So then look, on the 18th or so, it pierces 40, stays under there for a couple days. And again, we all know the story. There is nobody in a casino in Vegas right now, except security guards. There's nobody else in that casino. They're not letting them in. They're, you know, it's shut down. This is a shelter in place sort of situation for the casinos. A lot of folks had thrown the baby out with the bathwater. Now look at the 20th, folks. That was last Friday. So this is what Ricky was talking about, Ricky Sandler, when he's saying, you know what, at this level, I am more than willing to put my toe in the water here. and say, I just think that there's more upside than down. What we did, Joe, was we were putting on call spreads in some of these names, and I never, I'm not that guy that says I caught the bottom, I sold the top. I'm not that guy. But when we get a confirmation, Joe, when we get volatility in the 95th percentile, that's what we're looking for.
Yeah.
I'm looking for that absolute puke factor. And we got it in several of these names. Maybe not in the broad market, but in several of these. Look at how long it took it. I mean, from the 19th until, look at that. It doubled. And this is not a small company.
No, no. I mean, a lot of these doubled, and that's why, and I agree with you. No one claims they can pick the bottom or whatever, but one strategy to use is, let's say, it's down from 150 and it's at $60 or $50. You can use a call spread to define your risk. You can also say, let's just use round numbers. I want to buy 100 shares. What's wrong with buying 25 at 60 and saying I'm going to buy 25 more at 55, 25 more at 50, and then you buy 25 more at 45. And now there's a couple of things there. So now your average price might be 52 and change. So you don't get the dead low, but you have a nice bounce off of that to 60, 70, $80. That's what I'm talking about, where, I might hold something a couple of months trying to get a move of 30, 40% if I'm lucky, but you're getting that in a couple of days. Why wouldn't you flip that, or at least take something off the table? And the point I want to stress here is, if you use that strategy, you have to accept that there's going to be a little bit of volatility. You have to say to yourself, I have conviction in a name and I'm willing to take a little, start scaling into it. And if you get a bounce, there's nothing wrong with kicking out some of the position or locking in some profits off of that.
Let me throw some names out at you, Joe, and see what you think of the charts.
Sure.
Because some of these, quite frankly, are ones that I've been looking at and starting to nibble in some of these. I mean, Joe, when Disney fell 31%, and I'm only taking it from, when the United States really started reacting February 19th to the coronavirus. We all know that it was around before then. Not all of us, because I didn't think that it was going to become as big as fast, but I did, Joe, and I thought this was funny too. For every time I said this on CNBC, that I said, oh, we're going to see tens of thousands, if not hundreds of thousands of cases of this. For every time I said that, folks laughed at me. And I wish I was wrong. I'm just telling them what I heard from my dad, who's been a doctor. He's 92 years old. So the guy's been a doctor basically for, let's say, 55 years.
Yeah.
Or long, more than that, I guess. Sorry, Dad. But he's been a doctor for an awfully long time. And he said, John, there's no way that this virus is only going to do this much. It's going to be tens of thousands, hundreds of thousands of cases. We'll be lucky if it stays below 1 million in the United States. Now, everybody's saying it, Joe. New York is saying, oh, we could have over 20 million just in New York, the state, not the city.
Yeah.
So anyway, Disney. I got off track there, Joe. But Disney, what do you think of Disney? Or I've got another one, Cedar Fair, which is symbol FUN, FUN.
Yeah.
Take a look at those two and tell me what you think.
Yeah, I mean, like, let's start with Disney.
You don't have to make a call and say, buy them both, but I'm just saying, take a look and see, at what the chart, what is it showing you?
Yeah, I mean, so I use a guide, again, for a growth manager. I'm using a guide of the 50-day moving average, which is the red line here. And then, of course, my hardcore stop would be at 200 days. So when it gaps below that, someone like me, I'd get stopped out of. Now, that's my strategy. I always say, do what works for you. If you are a value manager, or you're saying, you know what, screw the technicals, this thing's down at $120, $100, there's nothing wrong with doing, like I said, scaling into it or doing a call spread. I mean, yes, we will look at this. I don't know if it's 3 months from now or longer. We will look back, and there will be some stocks that you'll say, why didn't I just, like quality names, that why didn't I at least add to my position, or maybe something I've been wanting to get into for a while, and people are going to be kicking themselves. And that's why I think there's nothing wrong with nibbling. You don't go all in. Tepper said he wasn't going all in. Just nothing wrong with taking smaller positions in something like this. Now,
Could you, Joe, hold up one sec? I think, at least for me, I'm still seeing Win on the screen. Are you seeing Disney on yours?
I'm seeing Disney on mine. Yeah, I don't know if
I'm not sure why it's not. I'm not sure if I screwed something up on my end, but
maybe go off of the screen. How do I go off of the screen? Where's the menu to go off of the screen share?
let's see. If you pull your screen up, your mouse up to the top of the screen, there you go. So now there's nothing on there. And if you go back down to screen share, you should be able to.
There we go.
pull
Oh, okay,
up,
yeah, I see them. I see the menu here. Okay.
There it is. Thank you, Joe.
Yeah, no problem. I think I'd lost the menu here. Yeah, so this is where I was sorry, I was drawing the lines. I use, you know, the 50-day moving average as a good stop, but you know, the 200-day is just, again, to manage risk. So I'll stop myself out, but there's nothing wrong. Like I always say, what works for you is if you start scaling in, even if you started early and you bought 25 shares at 120, and then you bought some more at 110, 100. I mean, you're scaling into this with the intent. That's what I'm saying. If you do the scaling part, it's with the intention that you might have to endure a little bit of pain or a little bit of volatility, but it's not a brutal pain, because let's say you'd normally buy 100 shares. If you got a quarter of your position, you can deal with a little bit of that with the understanding you're going to add to it. Now, you know, I think there's going to be some companies that I should say the problem with this strategy is the thing you have to accept with this strategy is patience. Like, you know, for example, it might oscillate around a little bit and do something like this before it heads back up. Who knows? It could also go back lower. But my point is, I like what you guys do with options to quantify your risk. But if you are going to buy some shares, there's nothing wrong with going small and giving it to just accept there's going to be some volatility.
Yeah, because there will be.
Yeah.
I'm just pulling up to see, Joe, what my, so when I say Cedar Fair, let me see.
Let me pull.
I'm taking it
that
back.
up and see if that did that come up.
Symbol fun, folks. So Cedar Fair basically was a stock that was, you know, give or take.
Did that come up there? Do you see that?
Let me see. Yes, sir. It's up there.
Yeah.
Thank you, Joe. When I see Cedar Fair, I'm looking here at, you know, a stock that fell off a cliff, literally, from like that 19th of February, you know, when it's north of 50, all the way down until it broke, as you see on your charts there, Joe, just to almost nothing, as if people are never going to go back to any of these, you know, amusement parks, if you will. I think that's, you know, an example of throwing the baby out with the bathwater. You are absolutely, for the folks that panicked in this one, I think it was the exact wrong thing to do. The low I have, Joe, was give or take $13.
Yeah.
50 to $13 in a month.
I can go to a to a chart. Yeah, this is a 60-minute chart. Yeah, you can see it went down here. 55. Yeah, this is 55 under 15. Yeah, low of $13. You're right. Yeah.
And look at it, folks. I mean, you had more than a double. And again, you didn't have to buy the bottom, but if you bought it at 15, you saw it moving back up. And then on what has happened this week, the gap higher. But all of those other moves from the 18th, 19th, 20th, that is, you know, against a market that is not exactly on fire down there, Joe. The market was trying to recover, and this one was seeing money flows in there in a pretty good way. So I'm just kind of throwing this one out as one of those that I would say, you know, Cedar Fair is one that I'd watch. You know, Expedia. We talked a little bit about the, you know, some of the biggest damage was done to some of the biggest companies like Marriott. MAR. Arnie Sorensen, he said that the outbreak was worse for business than 9/11 and the financial crisis combined.
Yeah, I believe that. I believe
These
that.
are companies that are going to need that bailout that just got passed through the Senate. Still got to go through the House, and then the president has to sign it. But these are companies that are standing to benefit. Benefit might not be the right word, but to get some of this much needed capital back in, because they are getting crushed.
Yeah. If I could talk about a couple of things. So the beauty
Please.
of this market is there's so many different ways to trade this, meaning there's value, there's growth, there's nothing wrong. I always say do what works for you. If you want to buy something beaten down, as I said, you could do it with call spreads, you could do it with smaller positions. I tweeted out a recent IPO SDGR that I actually added to this position today. Schrodinger, you can see develop software for drug discovery. It's sort of an artificial intelligence play. What I like about this is an IPO during a very difficult time at $17, you can see here, and it IPO'd and opened at 30, and then this thing just took off. And I know Kramer talked about this one as well on his show a couple months ago, and he was talking about on the pullback that this thing was going to go, but it got hit by the weakness in the markets. But what I do like is I pay attention to volume, and I see that on some of the big days, they've come in here, and then when it hasn't gone down, it's come down on light volume. I added to my position again. I nibbled in last week. I added a little bit at 40. It's a small position because I'm trying to add into strength. So this is sort of a smaller cap. 2.6 billion mid cap type of name. That's what that's what I love about this market is there's so many different ways, whether you're value, whether you're growth, even in the software space. One more real quick is something like Team, which I loved a lot of software names. And I love how, can you see it on your chart there, John? Or
Yes, sir.
Okay. I love how, I talk about the 50-day, it snapped right back and closed back above its 200-day, the black line here, and a 50-day, the red line here. And it's actually, when you look at a longer term weekly chart, it's actually coming really close to its all-time highs. So when a lot of stocks are 30, 50, 70% off of their highs, I'm looking more from a strength point of view of growth names that are showing relative strength, that when this is done, that have a decent probability of possibly working out.
Well, Joe, let me ask you about one that I've traded probably the most aggressively of any of the stocks that I've been following lately, and that's Zoom, symbol ZM. Not that I'm the smartest guy in the room, but log me in. Many of these companies that are remote work, I think are going to continue to do well. And I think they'll get the benefit of with the carryover once we get back to a normalcy, Joe. I think a lot of these will still do well because not because kids won't go to high school anymore and won't go to grade school. They will, but I think an awful lot of classes are actually better on some of these remote learning sites. And this might be one of them that you should really be paying attention to for that, because again, we use it, Joe, for cocktailing. When I want to get together with my friends from overseas or my friends here just a couple blocks away, but I know we can't go to a bar together, we'll have a cocktail hour, and we'll be doing it again tonight. Where we sit around and everybody just kind of chats.
That's a great point.
You get the social.
You're up, but that's a great point about Zoom. I've said that they were already doing great, meaning, this was an explosive growth company. Now the valuation's not there and people will complain about that. But like I always say, when you study history, some of the greatest growth stocks always trade at a premium to the market. You get what you pay for, because why is the valuation high? How many companies in this environment are growing their revenues close to 100% and growing their earnings triple digits? So they were already doing great. And then they beat their estimates in the recent report and guided higher. And to your point, I don't think this goes away. I think this is a wake-up call where not only is business going to pick up tremendously this quarter, I think it's going to continue to pick up as more people are going to be using this product, or in your case, having cocktails.
Yeah, I think they just get used to using it, Joe.
Yeah.
And I think the more that you use something that's new to you. Zoom isn't brand new. Log Me In isn't brand new. You know, many of these companies that do this distance learning or whatever are not, and I'm not talking about the for-profit education companies, folks. I'm talking about the companies that make exactly what we're doing, what Joe and I are doing right here on Zoom possible. I think these are companies that you want to keep an eye on for the future after we make this recovery, which we are making and we will make. Uh, by the way, Joe, do you think we need to retest? Are you that guy that says we've got to retest before we can get back to work upside in the
No,
market?
no, I mean, I'd like to see more stocks from what I look at for the real health of the market. Yes, I'd like to get us back above, certain key averages, and it's going to take time. I've been talking about patience, but I like to see stock set up. I like to see some stock bases set up. Combination of that with I do pay attention to, a lot of stuff you guys do with option flow, a little more consistency with that. Maybe some put writing showing that people are willing buyers in case we do go down lower. That'll be a bullish sign. I think biotech is also going to be a good spot as well because some of that's held up with so many of these companies, racing for some sort of vaccine or whatever. But I don't think we have to retest. No, I don't think it's necessary. I just want to see stocks set up to really show me that we can get at least a sustainable 6 to 12 week strong type of rally.
I gotcha. As far as volatility, Joe, since you mentioned it at the top, and it's, one of the bits of information that Pete and I really try to pay attention to.
Yeah.
Do you think that we will see a significant break in vol? Or do you think that vol has to stay high for months on end here? Maybe not in the 60s and 50s, but do you think it has to stay in the mid 20s to 30s range for more than, a couple weeks? Or do you think if it breaks, it's like a fever and it breaks and we make that inverted V like that
Yeah.
and
I
it
mean,
snaps down?
it's very possible. I wrote an article for Yahoo Finance that I said, we were already in a strong equity friendly environment, meaning interest rates were low and the Fed was doing what they called not QE, but they were doing repo buying and all this stuff. Now they've just opened up the floodgates. So what the volatility could stay up if we do get, the cases continue to increase and we don't flatten the curve, as they say. That could be a problem because a lot of industries are unfortunately shut down right now. So volatility could stay high until we get some sort of clarity, which who knows when that'll be. Or if the cases come down and we get another, the volatility might stay high, worrying about a second wave of cases. But when we do come out of this, what I wrote for Yahoo is now we were already in a great environment. We're going to be on an environment on steroids. I mean, the amount of trillions the Fed is doing with unlimited QE is going to really give a nice backstop for this market. The key is we have to fundamentally get past not only the virus and at least have that slow down, but get people back to work and have people going, back out. Now, a question I was going to ask you, which isn't really market related, is, don't you think people will, when things hopefully, God willing, soon enough clear up, do you think people are going to be in a rush to go back out to, movie theaters and concerts and sporting events and all these restaurants? Do you think that, it'll be baby steps with people being shy to get back out there?
I think it'll be baby steps, but I don't think that extends, Joe, all the way through the fall. So Major League Baseball, for instance, said that they hope to be back in May. That's interesting because obviously they were just in spring training, pitchers, catchers, a lot of these teams. And today, by the way, was supposed to be opening day. I was supposed to go out with my friends out in California. I can't remember if it was the A's, I think, that we were going to go out, Joe, and I think they were supposed to open today. And one of my friends that owns a vineyard out there was saying, this is months ago, not recently, hey, Doc, I got some seats for us. We're going to opening day, right? And because I was born in the Bay Area. I know an awful lot of folks there,
Yeah.
love the Bay Area. But I think, Joe, that if we, for instance, if we see that crest and that peak and the then rolling over of the amount of cases, and right now we know it's accelerating to the upside, not as much because more people are getting sick, but because more people can be identified
Right.
as having it. I think an awful lot of people have it, have had it, and are already over it. But obviously, this is a very deadly virus, and I think we're doing the right thing, trying to flatten out the curve. I think that's a smart thing. Don't overburden the hospitals. Let the people who are going to be the most likely to need the help, people that have pre-existing conditions, people that are older, um, and so forth, or people that are really stressed out, and operating right at the edge. I think those people are the ones that are going to need the ventilators and all the rest. And if we all went out again and said, screw it, 7 days is enough, I'm going back, I think we need to flatten that curve more so that there are those ventilators for the folks that are going to need them. I loved this today, Joe. I tweeted this one. Sir James Dyson, the guy that came up with that fabulous vacuum cleaner and the fans and the hair dryers, which I don't need.
I don't either.
or any of that stuff. Sir James Dyson basically pulled apart a ventilator, and he said, you know what? Covent, that's what he's calling his, the Covent. He made it and he's got orders for 10,000 of them already. Now, orders and delivery are not the same thing. We know that. But this is a guy, an inventor that has made things and done it when nobody thought you could, how are you going to beat Hoover? How are you going to beat Eureka? How are you going to beat all these vacuum cleaner guys that have been around forever? And all of a sudden he makes a better mousetrap. I think the same sort of thing here with Elon Musk focusing on this space, with Sir James Dyson focusing on the space. I think this is going to be something, Joe, that gets us out of this quicker. But we still have to flatten the curve as much as possible. And I'm enthused by what I see. And by the way, and I was talking today, I can't say the name of the companies, but I was talking with 3 different companies today that have rapid tests for COVID-19. And by rapid, I mean within an hour. One of them claims to have a 1-minute test. Now, I'm not saying the names of the companies right now, but I am saying that there are folks that are going to be providing tests. And the more we have of that, Joe, the more we're going to know that it's really, we have peaked and now we're rolling over. And to your point, when that happens, during that rolling over phase, that'll be the baby steps. When we see it dropping off sharply and people are able to say, yeah, I have these antibodies, which means that I can't get it again. We think, don't know that for certain, but if you have these 2 antibodies, they think that that means you've got it, your defense system is up for this particular virus. If indeed we're there, Joe, I think people are back in theaters. I think people are back on Broadway. I think they're back in Vegas. But, that's probably June, July, August in my mind.
Yeah. Yeah. And if that happens, and hopefully you're right, as far as things start to, we get some positive news, let's say it is a few months from now, and we do get a confirmed bottom in the market and a lot of stocks looking better, I think you can see a second half of this year that's going to be tremendous. And that's my point is not only because of the recovery, but you're going to have, forget the Fed on your side. It's on steroids. It's going to be off the charts. And then people will say, well, if we get good numbers, they're just going to hike rates again. No, they're not, because the election's coming up. They will not want to mess with the uncertainty of the election. And then you got the holiday season coming up, and they certainly don't want to mess with that because a lot of retailers have gotten smashed. So the earliest the Fed would do anything would probably be, first quarter of 2021. So my point is the teacher's going to be out of the classroom later this year, and the market's going to there's going to be some tremendous opportunities. We just have to wait patiently for at least, we're seeing signs of improvement, but we need to see at least a few more. I'd like to see 3 or 4 things on my checklist to really feel comfortable committing a lot of capital to this market.
Hey, Joe, now I know you do podcasts and you do,
Yeah.
you're featured on television. You've been on CNBC, Fox News, and of course, Yahoo Finance. Where should people go if they want to see more about what you're doing and where you might be providing information?
Oh, thank you. Yeah. I mean, a great thing. So I do manage money, and I appreciate you mentioning this. If I can just share this real quick, is I started a new educational product where I talk about a lot of these concepts. If you don't mind me sharing it really
Nope,
quick.
go ahead.
It's at joefahmy.com. And if I can just pull up the screen share here. There we go. It's at joefahmy.com/investor education. And this is where I used to run seminars years and years ago, and people say they couldn't come to New York or, travel and hotel and all that. So I recorded over 4 hours of these seminars to take you from start to finish of signs of a healthy market, when it is healthy, what to look for fundamentally, technically, and so forth. So that can be found at joefahmy.com/investor education. I talked about some of these names. There's plenty of idea generation, some weekend videos where I try to apply the concepts of the market to what's going on in real time with a lot of ideas. So it's great for traders for idea generation as well.
Fabulous. Hey, Joe, can't thank you enough, but I will try. Thank you very much for coming on with us today and sharing some great information. We look forward to seeing you on television or Yahoo Finance or your website, and continue the good work, my friend.
No, thank you for the opportunity. I love what you guys do as well. And you guys are just, I love not only being around smart people, but you guys are genuine, like brothers to me. So I appreciate the opportunity.
Likewise, you're like a brother to me, Joe. That's Joe Fahmy, folks, Zor Capital. Again, you can go to joefahmy.com to see more about all of his offerings. And I thank all of you for watching. We'll be reposting this and having it available, and Joe can retweet it and push it out as well. Thank you, everybody, for joining us.